This is Retirement Roadmap Radio with Mark Fricks from Master Plan Retirement Consultants. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Retirement Roadmap Radio with your host, Mark Fricks.
Hi again, and welcome to another episode of Retirement Roadmap Radio with me, Mark Fricks, your host, and our co-host today. The elusive Tony Shore is with us, and we're so glad to have him today, and he'll be popping in here in just a moment. But I did want to just wish everybody a happy day and a happy week, and hope everybody's doing well here in the Atlanta, Georgia area. We're thinking about entering fall. We're not quite sure yet, but thinking about it. But we're also thinking about something else. We're thinking about the economy, and we're thinking about markets and stock markets and that kind of stuff. So we're going to talk about that today. Yeah, as a lot of you that listen to me religiously know, we're not just an investment show, and we're not going to talk just about investments today. We're going to talk about actually how to recover from a stock market crash in retirement. What do you do if you're close to it or in it? What should you be doing right now? So we're going to cover that topic, and I think it's going to be a good one. In the meantime, Mr. Shore, are you awake?
I am alive and awake today, Mark. Thanks for asking. Thanks for having me on the show. I'm for better or worse, I'm a Minnesota Twins fan, and I actually wore my Twin shirt today. I didn't dress up for you. I thought today we would celebrate the Minnesota Twins. How about that?
Well, I didn't know whether to celebrate the University of Georgia football team or the Atlanta Braves baseball team, who is now in first place.
Yes, the Braves are doing very well. Yeah. My Twins are not, but that's okay. We've got an okay team this year, but not like the Braves. The Braves could do it this year. I think they could make it.
They're building something special, signing long-term deals, all these young kids, and it's, we may have some games ahead of us.
Yeah, I think it's exciting. It's exciting.
Yeah.
So, but we're not talking about sports today, Mark.
Why not?
Are we? Well, yeah, that's true. Why not?
It's my show.
That's true. You can talk about whatever you want.
Hi, welcome to Two Sports Guys, and no.
Yeah.
So.
Yeah.
But anyway, no, we won't. We'll talk about what we already said we'd talk about, so we can do that.
And that's good. I've had a great week, by the way.
Good.
How about you? How are you doing? Are you keeping busy?
Yeah, we start getting really busy about 2 weeks ago.
Right, I know.
People coming back from summer, they're ready to get things rolling again. It's hard to my calendar's packing up again, so which I love. I love to see the blue on my calendar because blue is meetings. So blue's my favorite color.
That's good. Yeah, mine too. Yeah, I like that.
Yeah, so it's all good. Blue sky, blue calendar. That's
blue shirt.
Blue shirt.
You like to wear the blue shirts, yeah.
Yeah,
I do too. But I didn't want a twin. I usually wear a shirt similar, and so I thought I didn't want a twin today, so I wore my Twins shirt.
There you go. Well, that's excellent thinking.
So what are we talking about today?
As I mentioned, what do you do if you're retired or nearing retirement and the market does what it's doing, which is I don't want to use the word crashing, but certainly it is in bear territory, and
sure.
It's kind of re-entering bear territory, it looks like, or at least digging deeper again.
I mean, for the year overall, I think that's a good question. If you're in retirement, what do you do when a year like 2022 happens, when the market's way down overall for the year, which it looks like, the market can do crazy things, and we want to be optimistic, but it looks like this is, even when all is said and done, we have a few months left, but I think it's going to be a pretty rough year for the market. It has been so far.
Yeah, I think so. And just a brief market commentary, there's a lot of things that Washington has done that has caused this. Inflation is certainly a driving force, and inflation is not because of Ukraine. Inflation is because of printing a lot of money for a long time.
Right. That adds to it.
I've been talking about that for 3 years.
But also $7 trillion in stimulus packages over the last two administrations. You can't. You literally can't do that. Plus all the new bills that the current administration.
With the student loan
spending.
It's like I don't know how much. I read a couple of trillion on if they pay off the student loans. It's just and so we got that going on. We've got, as I've mentioned before, a lot of people retiring. 80 million baby boomers retiring. We've got Medicare's in trouble. Social Security's in trouble. We want to spend more money on whatever.
Always.
And we want to raise taxes, which will slow the economy.
Always.
And they say, well, we're going to raise them on corporations. Well, guess who pays for that? We do. They have to raise their prices to cover their tax burden. So, I mean, it all comes down to the middle class. It really does. And then you've got the Fed trying to correct. Well, they're not magicians. They can't make the perfect move. So as they start slowing the economy down, how much do you break? And they're trying to break. And so I felt pretty good about 3 weeks ago, Tony, when the market had stabilized. We were bear market.
It looked like it was going to stabilize and maybe start back up.
Well, it did, but then the Fed came back out and said, yeah, but we need to do a little bit more. And then inflation peaked a little bit again. So I think we may have a double dip here. I do.
I would agree.
So that's why I think this is an important show to talk about what to do over at least the rest of this year. Give us time to get the correction built in. Housing market, I mean, I've got differing views on that. Some real estate people are like, oh, we're so far behind, we're still good. Others are like, hey, they're getting ready to sell now and start buying in 3 or 4 months when prices drop. So, it's nobody really knows, right? But
right. Yeah, nobody has a crystal ball, but we do know the market has been volatile, and all the experts and talking heads seem to think that that's going to continue throughout the year, and we see it heading back down again. So people who are just getting ready to retire are going to retire very soon, and those in retirement, those two groups, man, when you have a year like this, so what's something they can do or need to know about?
Well, so first of all, it depends on whether you're working with a retirement consultant. If you're working with an investment advisor or a broker that just sells stuff, their plan is stay invested.
Right.
By the way, my plan is probably stay invested too, but we're invested differently than just a broker. As you know, Tony, we have money divided up into different areas that react differently with the markets. So in a good market, our market money is doing well. In a bad market, our precious metals are doing well. Our insurance guaranteed products that guarantee principal are doing well. And so by having a mixture of money for retirement, our average client, I was running some numbers the other day, our average client is down between 3 and 7% because of the hedging, because of the protected accounts, and even because of the money that is in the market is being actively managed. So typically, historically, they perform better in a bear market and recover quicker. And
so that's a lot better. They're doing a lot better than the market is this year overall.
Yeah, they are.
It's way down overall. I mean, if you could be down 10% or less right now, you're beating the market by quite a bit.
Yeah, and that's what, because we only work with folks that are, getting ready for retirement. Usually it's 50 to 55 years old is when we'll start. And so we set this plan up knowing, guess what, Tony? We're going to have another bear market in 4 to 7 years. Yeah. It happens every 4 to, so why not prepare for it as opposed to hoping, hey, I hope things stay good from now on. They're not. They're always going to be up and down in adjustments. So
hope the markets don't take a hit and we don't have a bear market during my retirement. Well, it is going to happen.
Yeah. So
I mean, over a 20-year period, it's probably going to happen more than once. So.
Probably 2, 3, maybe 4 times. Absolutely.
Yeah,
so
exactly.
So what if you're a client of ours? What we're doing is we're reviewing your current plan. We might nudge something here. We might make an adjustment there. We may change income streams from to a different account. But you've got a plan. We've anticipated this. Now, if you don't have a plan, you need to come in now because probably you're going to panic, and you're probably going to sell at the wrong time. And so we need to get that money positioned in the right places. And people say, well, should we move to a different portfolio if we're down? Well, if we're moving from one down portfolio to another down portfolio that's better managed, you're selling low but buying low. So that's okay. So it's a good time to make adjustments. By the way, Tony, it's also a good time to do Roth conversions because IRAs are down. We're converting less money, but the same number of stocks, we're paying less taxes. Just a little tip. That's not one of part of my show, but anyway.
But it's still actually that's a tip that could help people deal with market volatility. If they have tax-free money, that's helping. I mean, it's not hurting. I'll tell you that.
Right. So I guess number one is either create or review your financial plan and just make adjustments as needed, but don't wholeheartedly just trash it. Or don't wholeheartedly just say we're going to do everything opposite of what we thought we were going to do. That's emotion driving that. And so either create a financial plan or review your current plan. And by the way, if you're working with somebody and their plan is like stay invested, call us. That's not a plan. That's called investing. There are about 12, as you know, Tony, we've talked about them all. There's about 12 areas that go into our retirement roadmap plans. And so if you're not having all 12 areas, then you're going to get bit by something along the way. And that's why it's so important to work with somebody that's holistic and fiduciary.
Yeah, there you go. And by holistic, you mean you look at everything, the big picture, and how things interconnect with taxes, investments, asset allocation, risk management,
income planning, Social Security
maximization.
Medicare. Yep, you're exactly right.
That's what you mean by holistic planning, and that's why I would encourage our listeners and viewers out there you need to work with a trusted financial services professional, an independent advisor and fiduciary like yourself, Mark. Our listeners need to be working with somebody that's going to help them more than anything deal with market volatility by having a plan that has actively managed money and doesn't have all your eggs in one basket. It's not all in the market, right?
Exactly. It's again, diversification, not from a standpoint of large cap, small cap, international, but from protected money, growth money, moderate growth money, tax-free money. As you know, Tony, we talk a lot about having buckets of money. We divide those big accounts into 5 or 6 buckets, each with a specific job, and we let them do their job, and that's what we do.
Yep. So there's a principal protected bucket where you have a lot of safety. There's a tax-free bucket with things like Roth IRAs or life insurance. That's tax-free money. And then there's, your high growth money, which would be stocks. And then you have a medium growth like bonds. And so, I think it's really important that people have a plan in place that's structured like that.
Yep. So let's go on to number 2, which is related, and that's you need to decide whether or not to continue investing. So this is where people can really mess up. The mounds of research by Dalbar, the research company that studies investor behavior, and the average investor that invests their own money in equities makes less than 3%. Because they zig when they should zag because of emotions. And
they end up selling low and buying high.
And I can draw a picture, if you can imagine. Don't close your eyes if you're driving, but if you can imagine that, as the market starts falling, you do what the pundits say to do: stay invested. And then it falls more, and you're scared, but you stay invested. And then finally, when the market's down 25, you go, I got to get out, and you sell. Well, guess what? You just lost 25% and locked it in. And it's going to take you 40% to get back to even. So we need to have a plan to do that. And part of my job, Tony, as you know, is emotional support. Let's do what makes sense, not what feels good, because that's 2 different things, right? And so again, maybe this is a time we take money out of protected accounts and put it into market accounts, because market accounts are down, protected accounts are not. It's called buying low, folks. I mean, and so that may be something we talk about in one of our meetings is do we make some transition from one bucket to another to take advantage of the low market? Is it going to go lower? It could, but it's already low. So I'm not going to guess the bottom of the market, but we certainly are much lower than we were a year ago. So that's, decide whether or not to continue investing is a much broader subject than it sounds like kind of on the top.
Yeah, it really is. And obviously, the DIY situation is not good. It's not conducive for dealing with a lot of market volatility, because you're going to end up trying to time the market. And just like Warren Buffett always says, it's time in the market, not timing the market.
Right. Yeah. And my other favorite statement from him, which is, when do you buy? When there's blood in the streets.
Yeah. When the market's in trouble and it's rocky and people are panicked because the market's in a bear market, that's when you put more money in, not take out. That's for sure. Yeah.
Yep. And that kind of ties into the third point here, which is rebalance and reassess your risk. Again, rebalancing could mean that we take some losses in some accounts that had some big gains somewhere. Now we take some of those losses and buy in lower with another different kind of stock or holding. It could be rebalancing your protected accounts versus your growth accounts. But reassessing risk is important. There's so many people that come in here and we give them 2 or 3 different risk tests. And, they'll come out, let's say they come out moderate, and I'll look at their statements that they brought over from somebody else, and they're aggressive. And I'm like, why are you not invested the way you feel? And either the broker didn't listen to them, or maybe he didn't give them a test, and maybe he really didn't have the conversation with them. Everybody's aggressive until the market falls. Have you noticed that?
Yeah, that's true.
We're all in when it's making 25% a year. I want all that, baby. But
people are excited and they're aggressive and they're like, this is the way it works. And then 2022 comes along and they're like, hey, wait a minute,
I'm not that aggressive. And so that's why we don't just have one big bucket that's all moderate. We may have, like you said earlier, a conservative bucket, which is where we go to for the first money behind savings account. Then we have a moderate, maybe 2 moderates. Then we have a moderately aggressive, might have an aggressive, but probably moderate aggressive is as far as we need to go if we're retired or nearing retirement. But having that balance, we leave the aggressive ones alone when the market's down. Yeah. And we tap into the protected and the conservative to live on, to spend, to buy the new house, the new car, or whatever. So again, you can't do all of that, Tony. It blows my mind that I come across and I see these old-fashioned money managers that have one big $500,000 or $1 million account. And you can't do 12 things with one account. I'm sorry, It cannot be done. It's like trying to build a house with a shovel. You can dig the foundation, but good luck hammering. Good luck sawing a board. You can't do it. So you need different tools for different purposes.
Yeah, it's like my dad always said, if all you have is a hammer, everything starts to look like a nail.
I like that. That's good.
Yeah.
I like that.
So, if you only have one tool, everything's going to look like a nail. And that's the problem with going to some of these big box places is they have their own products and that's all they have, and they say that's all you need. Well, there are so many different aspects of financial planning and making sure that you have money in different buckets. You need more than just a hammer because it's not all a nail, right?
Yep, exactly. Yep.
Yeah.
And again, reassessing risk, again, having a professional that understands the risk in retirement is important because we can judge, hey, we can't take any risk with this bucket right here because that's your guaranteed income for life. We cannot be aggressive with that because if it's down 20% and you're taking out $3,000 a month, you're going to run out of money. The math doesn't work.
No.
And so, again, it comes down to having a bucket for each job for sure. So.
Well, yeah, and I love the bucket approach. You've talked about it quite a bit, and I think that makes perfect sense. So what's next?
So the last two are, I'm going to use some language that the FCC may not appreciate here, okay?
Uh-oh.
I know.
I'll
you may
get
have to
my
beat
finger
me.
on the sense. Yeah, I'll get the...
Okay, so the next one is adjust your budget. I know budget is not a...
You said
I
budget.
said the B word. I said the B word. I know. So, but maybe you eat out a little bit less. If maybe you don't take that big vacation this year. Maybe you put it off 6 months. Maybe you whatever. Maybe you carpool. I don't know. Quit going to Starbucks. Go to Quick Trip.
But you need a spending plan. Maybe calling it a spending plan is a little better, but that's what it is, right?
Yeah. And we have these budgets we help people with. Pre-retirement budgets, post-retirement budgets that we can put together and help them. And I'm not saying write down in your little composition book every dime you spend, but we have little tricks of the trade that people can use that will help them do that. So, again, is it time to buy that new car? Probably not, because car prices are high and markets are low. So it might not be the best time to do that. I definitely don't think you should have bought a house in the last 6 months. I thought that was crazy. I mean, it was like a flea market, wasn't it? I mean, they had lines out front. I know some homeowners that were selling. They made you write an essay on why you wanted to live in that house in that neighborhood before they were able to consider your offer. I'm serious. Yeah. As a heart attack. I am serious.
And buyers were having to waive inspections, like not even have the house inspected.
As is, whatever that was.
Yeah. The contract said no inspection as is, and people were paying outbidding top dollar. Like whatever the asking price was, you got to go $5,000 more, or you're not even going to be in the running. Yep. I mean, the housing market went nuts, and that didn't help things in 2022 either.
Tony, when do you buy, Tony? When the market's low, not when the market's high. Now, I understand if you had to move, if you had to buy, I get it. I might have thought about renting for a year, but I get it. I get that. If you sold your home high and bought high, I get that too. That's cool. But, to sell your family home with 5 acres with 5 bedrooms and downsize and it costs you more money, no, that's not a good time to do that.
No. No, and that's another aspect of retiring is downsizing. And people who tried to downsize in the last year, that's a rough situation. We're moving into a smaller place, but it's costing us more?
Yeah, on a postage stamp lot, which is fine when you're retired. But to give up 5 acres or 2 acres with a big house and all the, and get what you got, wait. Don't let the emotions drive you.
Yeah.
So the last one, what was it? This is another kind of an ugly word. So go back to work. I know, and I'm not saying go back to your old job. I'm saying, if you love tools, go get a part-time job at Home Depot.
Yeah.
If you love, we got a CarMax. I don't know. I think that's a nationwide company, CarMax.
Yes.
And so it's a huge used car company. Yep. And so they have guys they hire and girls that they hire to drive cars from one location to the other.
Yeah.
So let's say I'm here in Atlanta and the car I want's in South Carolina. They'll drive a car up there, pick up that car and swap it and drive the one I want back. Yeah. They get paid for that, and stuff like that. It's Uber. You drive when you want to, whatever. I mean, there's lots of things out there. You love books, get a part-time job at the library. And I'm not saying do it forever, but an extra $1,000 a month could actually, so certainly help you out. So again,
more people are working in retirement.
They are, and there's a lot of jobs out there. So there's certainly those things that are available. I've always wanted to start a new business, Tony. Well, I shouldn't really say that. I've always had an idea for a new business, daycare, and have the elderly be the caretakers.
Yeah.
Because they love kids.
Yeah.
Yeah. So people that are 60 to 75 that just love children, love holding them, love taking care of them. I think that'd be the best care in the world.
You're not, unfortunately, I have to tell you, you're not the first one to think of this. Now, the daycare where we sent our kids is in one of the nicer senior living centers, and that's where the daycare is. And they bring the kids around to talk to the seniors and bring them in. And they bring the seniors and kids together for story time.
Oh, perfect.
Yeah,
perfect.
And movies. And live music, and it's seniors and kids mixed. So that's starting to happen in some of the newer assisted living centers. They're putting in daycare centers.
That's a great idea. I thought of it about 25 years ago, by the way. I just haven't done anything about it. So.
I didn't trademark it. Sue for royalties, yeah.
But I hadn't thought about combining the two. That's really cool. That's an excellent idea.
Yeah, and senior living centers and college campuses are building senior living centers so the students can work there and the seniors can go to classes and utilize the library
and share their life.
Arizona, I think Arizona State or Arizona one of the big Arizona universities is doing that.
Very cool. Very cool. Yep. Good stuff. Well, that's my points for today. I don't know how much time we have. I think we're getting close here.
Yeah, we got about a minute left, which is a perfect amount of time for you to let the listeners know about the special offer you have for them and how they can get a hold of you and set up that complimentary consultation.
Yeah, so again, I try to keep 3 or 4 openings a week for what we call complimentary consultations. I call them chats, financial chats.
Yep.
And it's just a chance. It's 30 minutes, give or take, for you to ask me anything you want to ask me. You can ask me about how we work. You can tell me about your situation, your goals, your problems, your concerns. And if the meeting goes well, I'll run 6, 7, 8 reports to tell you where you are and where your problems are. That's complimentary too. So the first 2 meetings, no cost involved. You can walk away and say, hey, now I know what I got to work on. I'm going to go work on it. Many times people go, yeah, I see what I got to work on. Can you help me? We'll help them. I mean, so that's kind of why we do this, right? But it's at least find out where you're at And are you going to be where you need to be? So how do you do that? Well, I'll tell you the very easiest way, Tony, is to visit the website. There's a button there that says schedule an appointment. My calendar pops up. The calendar on the left says initial consultations. You pick the day, the time, and guess what? I'll be there. Okay, so you pick it. I'm there, whether it be Zoom, phone call. If you're in the Atlanta area, you can come to the office. Totally up to you. I do some traveling throughout the Southeast, although not as much as I used to. But masterplanretire.com is the easiest way. And that will also lead to our podcast, which there's over 100 there now. You can go to the major podcasts, Spotify, Apple. Was this two? I think two more, Tony.
Google, Amazon.
Yeah. So just type in either my name, Mark Fricks, Fricks, or Retirement Roadmap Radio, and you'll get over 100 podcasts. Visit our YouTube channel, Retirement Roadmap Radio. I've got probably 3 or 4 dozen short and longer videos about everything we talk about here, even federal workers. I got some videos for them as well. But really, more importantly for you folks that are listening, I got 3 to 4 openings, and if you do schedule that and attend that chat, I'll send you a signed copy of my book, complimentary. That's about what we talk about here. It's about retirement, not investing. So that's the offer, Tony. Masterplanretire.com is a great way to find out more about us and schedule that chat.
All right. Thanks, Mark. And listeners, that does it for today's episode of Retirement Roadmap Radio with our host, Mark Fricks.
And thank you so much for joining us. It means a lot to us that you trust us to deliver knowledge and information to you. That means a lot. We love providing the knowledge, the education. Didn't mention it, but on masterplanretire.com is always workshops, typically Zoom workshops that you can attend, no charge. But anyway, until we see each other again, remember, folks, plan well and prosper. Have a great day, everybody.